Hi traders, you're welcome back once again to the Bullish Bear FX Academy. My name is Tim Leja and I'm super excited having you all here today on this one. So you're welcome back once again to the 2024/2025 trading syllabus. Here in this channel, our goal is to teach you a whole lot you need to know and probably everything you need to know about trading from start to finish till you become a professional in this. And the goal is we want to take you guys step by step until we make sure that you are good in the trading industry. So what you want to do in case it is your first time here is to hit the subscribe button, turn the notification bell on, and please, as a way to show the support and as a way to show that indeed you appreciate our efforts and what we're doing in this channel, make sure to hit the like button. And at the course of the video, if you have any question, please do not hesitate to drop them on the comment section, because based on your question, I will understand where you need more explanation and know how to teach you more even in subsequent videos. All right, so make sure you engage in the comment section. So let's get into the main video. What is Forex? Forex is a short form for foreign exchange. And what is this foreign exchange? What are we exchanging? Is the exchange of currencies. All right, now the Forex market is actually the largest financial market in the world, having over $5 to $7 trillion flowing in and out of it every single day. Every single day, 5 to 7 or even more $1 trillion flows in and out of the financial markets. And that is why a lot of people can get rich with this business. Why? Because this huge amount of money that are being pumped into the financial markets, a lot of traders are out there to take advantage of grabbing this money also. All right, so that is why you're here to learn, because you want to learn how can I grab this money when this money is flowing in the market. How can I be a partaker of it? That is why you're here. All right, so foreign exchange is the process of selling one currency to buy another, or to buy one currency in order to sell another. All right, so what is this currencies that you are selling or buying? The currencies are what? The currencies of different countries. Every country has his or her currency. US have the US dollars. All right, the London has their Great Britain pound. Japanese have their yens. All right, South Africa have their ZAR. Nigeria has naira. These currencies are what we are in the market to do what? To exchange. Okay, so what is trade? I'm breaking it down. We have Forex exchange and we have Forex trade. So what is trade? In a layman understanding, all right, we all were taught back then in school in commerce or so that trade is what? All about the buying and selling of goods and services, right? Buying and selling and exchange of goods and services. So when we talk about Forex trade, we are actually saying we are buying and selling or exchanging currencies. All right, so that's a very simple way to understand what the Forex trading is all about. Now, there are two types of Forex trading. The number one, the physical Forex trading market. The physical Forex trading market is, we all know, when you travel from one country to another, all right? For instance, you're traveling from South Africa and you go into America, all right? Now, as a South African, you have the ZAR. Now, when you go to America, you cannot use ZAR currency to buy anything in America. For you to be able to purchase anything in America, number one, you have to make sure that you exchange the ZAR into US dollars. The moment you exchange ZAR to US dollars and you take US dollars to any shop to buy anything, then you know that, yes, you have arrived. All right. So the ability for you to change the ZAR into US dollars, all right, in order for you to be able to use it to buy something in America, that is what we call physical Forex trading. All right. And how did you change it? You went to the exchanges, money exchanges. All right. That's where you actually went to change that, or probably you changed it in the airport the moment you landed in from South Africa to America. The moment you landed in the airport, you exchange the dollars quickly. All right. So those men or women who stand by the way in order for you to give them ZAR so that they can give you US dollars, those are who we call Forex traders. And you and them, actually, both you and them are the Forex traders, because you have given them ZAR, they've given you dollars. So this is what we call physical Forex trading. Now, how actually do they make their money? That is the next question you might likely ask. The way they make their profit is when you come to them with ZAR, all right, let's say you have 100 ZAR, okay, and you want to buy, let's say, $100, all right. If you want to buy $100, now you're going to ask them how much $1 cost in ZAR. If they decide $1 is equivalent to 5 ZAR, all right. If they say that $1 is equivalent to 5 ZAR, then you would have to make your calculation. Since what you have is 100 ZAR, you're going to divide your 100 ZAR by 5, right? And that's 20. So it simply means that you're going to get $20 with your 100 ZAR. All right, you're going to get $20 with your 100 ZAR. So if you ended up spending 100 ZAR to get just $20, then you decided that, oh, I don't want to use this $20 to buy anything. I would love to resell these dollars so that I can make profits. Now, what you want to do is to hold on to that $20 for a while. And the moment you notice that the market has increased in price, probably at that time, it might likely be that this $20 which you bought for 100 ZAR has increased to something like, let's say, $30 for 100 ZAR. Okay, $30 for 100 ZAR. That simply means you made $10 profits. All right. The ability to hold the money, waiting for price to go up so that you can resell the dollar you have, is what makes you profits. And if you hold that money and dollar falls and keeps falling and you sell that dollar off, you're going to make losses. All right. A lot of traders actually do make losses. I'm still talking about physical traders, especially maybe when they have bought enough dollars. All right. When they arrived in America, they bought enough dollars with their local currency, and probably they didn't spend all the money, and it's time for them to travel back. And they know for sure that if they travel back, this dollar is not going to make sense to them in their own country. So they decide to sell it off in order to get their local currency back. And probably it could be that dollar has fallen at that particular time when you needed to exchange that dollar back to your local currency. So if dollar had fallen then and you just like, man, there's no other option, I just have to exchange this money right now, you're going to actually be in loss. Okay. That's why you end up seeing some people sometimes would decide to take that dollars and travel to their own country, because they just want to hold it for a while to see anytime dollar rises, they can decide to go and sell it. So this is how the physical Forex traders actually make their profits. Sometimes it can be a little bit hectic, you know? So that's what makes you different from them, because you're not trading physically, but you're trading digitally. And that brings us to the number 2, digital Forex trading. The digital Forex trading is the state whereby you can actually buy these dollars or sell these dollars with your phone or with your laptop digitally from anywhere, from your home, from your office, in the toilet, anywhere you are, digitally. That is what we are actually here to learn, how to trade digitally. When you hear people say currency pair, what is really the meaning? Now, currency pair is the combination of 2 different currencies. When you hear currency pair, it means a currency is pairing with another currency. So when you bring USD and pair it together with GBP, that makes it a currency pair. If you don't have two different currencies pairing together, it's not a currency pair, but rather it's just a currency. Okay, it's just what? A currency. Now, when we have currencies that are paired, all right, we have things to be like this. We have, let's say, euro, right? And we have USD. Now, this is what we call currency pair because we have the two of them together. Now, this first currency here is called what? A base pair, and this is called the quote pair. All right, so this is called the base pair. Is the base, that is the foundation of the pair. So it's called the base pair because it is what you want to buy. All right, and this is called the quote pair because this is what you want to sell. You want to sell USD in order to buy euro. All right, when you see things like GBP and against USD, it simply means that you want to sell your USD in order to buy GBP. If it was the physical Forex trading, it simply means that you're probably in London, all right? And that's why you want to buy GBP and sell off the USD. So it simply means that you're coming from America and you want to sell off USD to get GBP because GBP is what we call the Great Britain pound. That is for London, right? The Britain, GBP. Why USD, US dollars, all right? It's going to be your base and this is going to be your quote. You're selling this off because you want to buy this. So the first currency in every pair is called the base pair. Don't forget why the second currency is called the quote pair. The most popular currencies traded in the market. You have euro, slash USD. Number two, you have USD slash JPY. All right. Number three, you have GBP slash USD. Brazilian dollar. All right. Aussie and USD. USD card. CAD card. All right. NZD. USD. Now, these are the 7 most popular currencies, actually called major currencies that are traded in the markets. USD, CHF. Please, this is not P, this is F. Don't mind my handwriting, okay? They are considered as the major currencies because these are currencies of countries that their currencies are well recognized, all right? And their currencies have values, real values in the markets. These are currencies of, or these are countries whose currencies are being recognized well and worldwide, and Forex traders are busy pumping money into it on a daily basis, much more. It is also considered the major currencies because these are currencies that have high volatility in the markets. The market is moved by volatility. When there's no volatility in the markets, the price moves very sluggish. All right. Sometimes it doesn't even move. If it ever moves, it moves very sluggish. You just see the candlesticks chopping and chopping and chopping. Why? Because there's no volatility in that market. But when you want to trade markets that have volatility, you would see the candlesticks are very healthy. Either it's booming up or it's booming down. You understand? That means there's good volatility in it. And these ones are considered as the major currencies because you have people pumping money into US dollars. You have euros pumping money. All right. You have the Japan. They are constructing every day. They are doing this every day. They are bringing new projects every day. Japan is always working hard every single day. So there is no way you can exempt their currencies from major. All right. You have the pound, London doing awesome, the Britons doing wonders, creating job opportunities here and there, a lot of things happening in the Britain. That is why their currency is always booming and booming. That does not mean that every other countries ain't doing well with their currencies, okay? But just this is for you and I as traders. We know what we are here for. We want to trade only what is going to give us money. All right. Forex languages that you must understand. One, currency. The currency is the commodity that are being traded. Number two, currency pair. It is the combination of two different currencies. Okay. Number three, we have PEEP. PEEP is the smallest number that moves in a currency, or you can actually say PEEP is percentage in price. That is the full name of the abbreviation, PEEP. It is the smallest number that makes a move or that moves in the currency market. When you're on your charts, you'd see price. When price is moving up, you will see it's increasing by 1, 2, 3. If it's going back down, it goes back to 2, 1, 0. You understand? So those little numbers are what we call PEEP. By the time you make the calculations inside of those numbers, you'll be able to find out what is the percentage in that price movement. Number 4, we have what we call bull or bullish. All right. This simply means when price is in an upward direction. Number 5, we have bear or bearish. All right. This means price is in a downward direction. So bullish for upward direction, bearish for downward direction. Number 6, we have what we call consolidation. Consolidation or range. All right. It also can be called indecision. I don't know who wrote this, who drew this red marker on my board. Please, if you're the one, kindly use the eraser to clean it off, okay? Or don't mind my handwriting, okay? Indecision. The three of them are all the same thing. Consolidation, range, or indecision simply means that price is not going bullish, neither is it bearish. It's just moving straight. It's not going up. It's not coming down. It's just moving straight, sideways direction like this. All right. So a bullish direction is like this, right? A bearish direction is like this, right? But a range goes straight. So at this time, at this phase is called consolidation, range, or indecision. When there is no direction for the market. For instance, let's say London comes in with 1 billion pounds. How do I even write this? 1 billion pounds. Okay. GBP. And they came in against US, and US came in with $1 trillion. All right. USD. US dollars came in with $1 trillion. GBP came in with 1 billion pounds. All right. If this $1 trillion is much greater than pounds, or if there's something wrong with the Britain economy, all right, that makes their currency lose value, and then suddenly this US dollars that is the quotes suddenly becomes strong in their economy, all right, this market will be bearish. If anything is wrong with Great Britain economy and their 1 billion pounds fails in value or loses value, and suddenly the US dollar, which is $1 trillion US dollars, all right, is strong in their economy, this market will be bearish. Remember what I told you, that this is the base. This being the base means that you are selling USD to buy pounds. This means that on the norms, this market is meant to be bullish, which means GBP is strong. That is why you're selling off your USD to buy GBP, because you don't want to buy something that is not making sense, right? So you want to buy something that makes sense. That's why you're willing to sell off USD to buy pounds, because it's bullish. If anything happens to the economy of the Great Britain that makes their currency begin to fall, okay, it simply means that this US dollar is strong. Because for pounds to continue to go up means that US dollar is still weak in their economy. They are weak. It might just be that Britain is still stronger than them. And that's why the market will have to still be bullish. If Britain loses strength in economy in any way, maybe probably because of unemployment, or maybe some kind of thing just happened around, okay, by the time we start doing fundamental, you will begin to see some of all these reasons why a currency can rise or fall. All right. I just don't want to go back, going deep into there. I just want you to see and understand how these markets move. All right. So if anything happens to the economy of Great Britain that makes their currency fall, US dollar will be stronger than it. And if US dollar is stronger than it, it simply means that the market will keep falling. So the more the market is falling, okay, the more the market is falling, it simply means that anybody who placed a sell would be making money. For Great Britain to be falling means people are buying the Great Britain. People are selling US dollars. All right. They are selling US dollars and buying Great Britain. That's what it means. That's why I said they are selling. Okay. Because I know some people might be a bit confused now. Why should I sell since Britain is falling? You should sell because you're selling dollars to buy the pounds since it's falling, because you know that by the time you buy it and hold it, when it rises, you're going to be in profits. That's the back end understanding of the market. You're selling US dollars. That's why you place a sell when pound is weak. Okay. And then if pound suddenly bounces back up and starts gaining strength again, you as a trader want to start buying. So when one country's economy is stronger than the other, this is what happens. The market goes either bullish or bearish. But when the two countries' economy are strong, the market will be consolidating indecision. Why is the indecision occurring? Because the two are strong. All right. The bulls are trying to push up. The bears say, no way, I have a lot of money. The bears are trying to push down. The bulls say, come on, I too have a lot of money. So they continue to consolidate until one person fails in one way or the other. And then you see price breakout and continue to the upside or to the downside. By the time we start dealing with our charts, you begin to understand these things properly well.